Okay, let's talk about carbon disclosure. You've probably seen this phrase popping up all over the place, right? In business news, investor reports, climate talks, it's become a huge buzzword. But what does it actually mean? And maybe more importantly, can we really trust what companies are telling us? Let's get into it.
So at its heart, carbon disclosure is actually pretty straightforward. You can think of it like a company's climate report card. It's where they're supposed to be totally open about their greenhouse gas emissions, and then show us their plan for handling climate-related risks. It's all supposed to be about transparency.
And, that leads us right to the million-dollar question. With all this pressure on companies to be green, are they really telling us the whole story? Or is there a big difference between what they say they're doing and what's actually going on? Well, to get to the bottom of this, a group of researchers did something really smart. Instead of doing just one more study, they did a study of studies. They took a look at 278 academic articles published over 2 decades and basically mapped out the entire history of this conversation to see how it's changed over time.
And what they found was that this field of research just exploded. For years, there was just a slow trickle of studies, starting back in 2004. But then, bam! Look at that huge spike right after 2015. That is absolutely not a coincidence. The Paris Agreement in 2015 was the turning point, the catalyst that took carbon disclosure from this niche academic topic to a massive global priority.
So, who's actually leading this charge in research? You might think the US would be at the top, but it's actually China, by a long shot, with Australia coming in at a strong second. These two, along with the US, are really the academic powerhouses pushing this conversation forward. And there are some pretty clear reasons why it's these countries. It's kind of a perfect storm of different factors. For China, its incredible industrial growth made it super urgent to track environmental impact. Meanwhile, Australia and the US have these really strong academic systems and a lot of regulatory pressure, which just fuels this kind of research. But this is where the story gets really, really interesting. The research didn't just get bigger. The entire focus of the conversation took a major turn. It went from just asking if companies should report to a much more critical, much more skeptical point of view. The analysis found 4 distinct stages. In the beginning, the question was super basic. Hey, should companies even be reporting this stuff? Then it moved on to, okay, if they report, does it actually affect their financial performance? But then came the scrutiny phase, where researchers started asking, wait a minute, are these reports even real? And do they lead to actual improvements? And that, of course, brings us to where we are today, with the number one concern being, is this all just greenwash? Yep, greenwashing. That one word has pretty much become the main event, the central conflict in the entire carbon disclosure story. It's the big puzzle that researchers, investors, and all of us, really, are trying to solve right now. So let's be clear on what we mean by greenwashing. It's basically when a company puts more effort, time, and money into marketing itself as eco-friendly than it does into actually being eco-friendly. It's all about looking good, not necessarily doing good. It's perception over reality. And the difference between the two is just night and day. On one side, you have genuine disclosure. That's about full transparency, real emission cuts, and building trust. On the other side, you've got greenwashing. That's all about cherry-picking data, managing impressions, and making misleading claims. And that approach, it creates a huge risk to a company's reputation. And the stakes here are so high. The real danger with greenwashing isn't just about one company fibbing. It's that it can poison the well for everyone. It completely undermines the credibility of companies that are making genuine efforts and makes it almost impossible for investors and customers to know who to trust. Now, the good news is, the research also gives us some answers. There are concrete things that help keep companies honest. Things like strong corporate governance, having independent directors on the board who can ask tough questions, and solid government regulations all make a huge difference. And of course, good old-fashioned media scrutiny. That always helps keep people on their toes. So all this brings up a really fundamental question. If it's so complex and there are so many risks, why do companies even bother disclosing their carbon data in the first place? What's in it for them? Well, research suggests it boils down to 3 main theories. First, you've got legitimacy theory. That's the idea that companies disclose this stuff simply to look good and gain social acceptance. Then there's signaling theory, which says a company discloses to send a positive message to investors, basically saying, hey, we've got our act together. And finally, there's agency theory, which is more about internal alignment, making sure managers and owners are on the same page by reducing secrets. So here's the key takeaway from all of that. Carbon disclosure is never just a simple report filled with numbers. It is always a strategic move. It's a calculated decision that's driven by this complex cocktail of outside pressure, the desire to shape public perception, and, of course, the need to show strong financial performance. And that leaves us with a huge question for the future. As the demand for real climate action gets louder and louder, the line between real, honest-to-goodness transparency and just clever marketing is going to get even more blurry. The challenge for all of us, whether we're investors, customers, or just citizens, is figuring out how to tell the difference.